So let's quickly chat a little bit about tax directives. First explain, and we're going to talk here about individual tax directives. People who earn a commission or they're self-employed, etc., etc. How does those tax directives work? And when do people use them?
Okay, so a tax directive is an instruction from SARS for an individual that you can give to an employer, or if you are an independent contractor or a personal service provider, that you give to the company that you're employed by to say, this is the instruction just saying that this tax rate is applicable. So regardless of whether your income falls within that tax bracket, they need to apply this tax directive. It states that the employer cannot deviate from this.
Yes.
A tax directive is applied for in advance. You can't apply it historically. So you can only apply it from the day it was issued for the next 12 months. You have to renew that application every year.
Yeah. Okay.
This tax directive you apply for does not override Income Tax Act. So that means even though you're employed, the employer is deducting a specific amount from you consistently regardless of your income. By the end of the year, when you file your tax return, normal income tax rates will still apply.
Yes.
So some people face the danger, especially commission earners, because it fluctuates a lot. That, let's say, for instance, you apply for a very low percentage tax directive and SARS approves it. Your employer will apply that throughout the tax year. Then come the end of the year, you file your tax return, and then you've under provided in this tax directive, and you're most probably going to pay in.
Yes.
But there is a benefit, because commission earners can claim certain deductions that instead of having to claim back a huge amount at the end of the tax season, you can apply that throughout the tax year to better your cash flows.
Yeah. So basically what happens is, instead of you doing your tax, paying full tax during the year, and then that money sits in a SARS account somewhere, they get all the interest and the benefit from it, and then end of the year you're given all your expenses, your deductions, all of that, and then you get a refund from SARS. With a tax directive, you pay less every month, so that money stays with you, and then at the end of the year you just get a smaller refund.
Yeah, or you'll have to pay in. It depends on how much the directive you've applied for.
Yeah.
This will apply to individuals whose income fluctuate every month. This is just to stabilize your monthly income, because we all have fixed monthly expenditure and we need a certain amount to survive every month. So if your income is jumping from 20,000 to 50,000 to 30,000 to 10,000, you can apply to SARS for a tax directive, give that directive to your employer, and your employer will apply a consistent. It does not mean your tax will not differ on a monthly basis. You will just be taxed on the same tax percentage every month.
So I think the one thing that we need to address, and you can just share that with the listeners as well, is I've seen it so many times that the employers, especially who has reps and salespeople that work on commission, the employers almost make it as a company benefit that you can get a tax directive because you are now a commission earner, and so they sort of sell it as this global benefit to have a tax directive. But people need to understand that tax directive can be a bad thing for you as well if you don't apply for it at the right time, when you're at some place financially where it's worthwhile doing that.
No, definitely, because you don't want a company can apply on behalf of an individual for a tax directive, and you don't want your company to apply for a too low rate. So by the end of the year, if, let's say, for instance, consistently through the financial period, the tax directive was applicable, you were taxed at 31%. By the end of the year, your marginal rate was actually your 36%, sorry. Then you're going to have to pay tax in. So it will not be to your benefit.
Yeah. And then also remember, if you want to apply for a tax benefit, when you work on commission, you pay normal tax. You pay on certain levels. So if you don't pay tax from Rand 1 at that percentage, it differs. Where if you have a tax directive from Rand 1, you're going to pay 18%. So it could be that this month you're only earning 6,000 Rand, so there's no tax payable for this month. If you're on a tax directive, you're still going to pay that 18% or 20% or whatever.
That's correct. And most payroll systems today, they account for your whole for your annual tax. So if month 1 you've got a low income, month 2 you get a higher income, the payroll system will offset against a prior month as well. So regardless of whether your tax rates jump every month, the payroll system will usually average it out for the year. So by the end of the financial period, you don't have to pay in or have to claim back. So you break even on that.
And you might have some months where you have a good month, or a bad month where you actually get tax back on that monthly basis because you'll have a negative tax for that month. I've seen it with the people that work for us, where I get the payroll and they have negative tax. So I'm basically paying them
There's
extra.
a possibility of a negative tax. There's also a possibility that, let's say this month you only do 10,000, next month you do 50,000, and you'll expect a higher tax next month, and you see, oh, my tax is lower. That is because the payroll software automatically averages it out for the year.
Yes. So then I want to jump. I'm going to jump past the deductible expenses for now, because this takes us into this thing about marginal and effective tax rates. People have no idea what their actual tax rate is. They don't know what they're paying. They just hear this, I'm in super tax, so I pay 45%. But it doesn't get to 45%. So I think if you can explain to the listeners the difference between the marginal and the effective rate, and when you look at those effective rates, it's actually much lower tax than people actually think they are paying.
Yeah, look at the income tax brackets as steps. Your first part of your income is taxed at a rate. The next part is taxed at the next rate. The next part is taxed at the next rate. So that means each portion of your income is taxed at a different rate. That is your marginal rate. By the end of the year, end of the day, when you include your tax credits and all of your deductions, and you take your tax liability, your tax payable to SARS, and divide that as a percentage of your income, then you will get to your effective tax rate. And your effective tax rate is 100% of the time much less than your marginal tax rate.
Yeah. I've got the tax tables open here for 2022, and from Rand 1 until Rand 216,200 for the year, you're paying 18%. So 216 is almost what's 19,000 Rand a month. You're paying 18%. From 216,200 to 337, you're paying a fixed amount plus 26% over 260.
That's correct. And that fixed amount that has to be added to the percentage is the portion at 18%.
Yeah.
And so the brackets goes up
the whole time. So the maximum is 1.6 million and above. You've got 587 plus 45%. So it's not 45% on your income.
No.
Is you've got that fixed amount plus then the 45%. So if you do go figure out your average tax rate, your actual, what do you call it, effective tax rate, before you look at a tax directive, for example. I did a calculation the other day. If you have a tax directive for 20%, for example, you will only have to earn, or you will have to get to over 35,000 Rand a month before your average tax rate will go over 20%. So if you're not earning that, don't get a tax directive for 20%, because otherwise you're going to pay more tax every month than you would have. And that's not the idea behind a tax directive.
Yeah, definitely. And I've also realized individuals are under the impression if they get a bonus, super tax is applicable to a bonus. That is not the case. Usually a bonus is paid out in December, and the tax year only ends in February. So what the payroll software will do, once again, it averages it out. So it will say, okay, December, January, February, that's 3 months. So it will split that portion as if though you received a consistent amount over the next 3 months and apply that tax rate. Right. Or what they can also do is they will deduct the full amount from the bonus itself, and that's why in December specifically, when you receive the bonus, your tax might seem high, but the next month it's lower, so it's averaging it back to what it should be for the full year. So the thing that people think a bonus automatically 45% tax applies to a bonus, that is not the case.
Yeah, it all comes down actually to what are you earning for the year. What you're earning every month isn't actually what they need to calculate your tax liability. It is what you have earned for the year. So that bonus is just part of whatever you've earned for the year. So if they just add it for that 1 month, your 1 month income would go higher, but it's still at the end of the year when you do your tax return, they're going to look at the total income for the year, and it will be in exactly the tax rate as you would have earned in any case, unless it pushes you into a different bracket. Am I right?
Yeah, so for salaried individuals, there's various allowances and various structures to your salary. You can earn a commission, but again, your commission will be taxed 100% by your employer, but you are allowed certain deductions against that commission, so you can claim money back. Allowances as well. Travel allowance is only taxed at an effective rate of inclusion rate of 80%, but you have a travel logbook which you can claim against that and reduce the value of that income portion. It can be as little as zero, so that portion falls away in your annual tax calculation.
Okay.